All right, we're going to look at Chapter 7, which focuses on stock market efficiency and kind of stock price behavior. So we'll look at some criticisms of the efficient market, or beginning to think about criticisms of the efficient market, and also look at what it means to possibly beat the market. So just a few different things, little quotes about the market and kind of like this elusive nature of it. So at the end of this, I'm hoping that you'll have an understanding of the foundations of market efficiency, the implications of those, and how professional money managers and market efficiency work, and then some anomalies and bubbles. So we start by asking the basic question is, can you as an investor consistently beat the market? In this particular scenario, many people believe it is impossible for you to beat the market. And evidence includes that this is probably not going to happen. You've heard me say the stat of 75% of mutual fund managers don't beat the S&P 500. So we'll describe some phenomenon that sound like, these different ways the market is affected, such as the January effect and herding and these types of behaviors, and kind of look at those in relation to market efficiency. So the efficient market hypothesis basically says that major financial markets reflect all relevant information at any given time. And market efficiency research basically looks at the relationship between stock prices and this available information. And the important question is it possible for investors to beat the market? But EMH series says if a market is efficient, it is not possible to beat the market except by luck. So the excess return, what exactly is that? That is a return in excess of what is earned by other investors that have the same type of risk. So to judge if an investment beats the market, we need to know if the return was high or low relative to the risk involved. We need to determine if the investment has earned a positive excess return in order to say that it has beat the market. So there are some foundations of market efficiency, and these three economic forces can lead to market efficiency, and they are so powerful that any one of them can result in market efficiency. These conditions are, number one, investor rationality. If every investor always made perfect rational investment decisions, earning an excess return would be difficult. If everyone is fully rational, then equivalent risk assets would all have the same expected returns. So put differently, there wouldn't be any bargains because all prices would ultimately be correct. Second condition is independent deviations from rationality. It says even if investor rationality does not hold, the market could still be efficient. Suppose that many investors are irrational and a company makes a relevant announcement about a new product. Some investors will be overly optimistic, while some will be overly pessimistic. But the net effect will ultimately cancel these out. So in a sense, the irrationality is just noise that is diversified away because you have them on both sides. As a result, this market could still be efficient or nearly efficient. What is important here is that irrational investors do not have similar beliefs. The third condition is that arbitrage is arbitrage. So suppose there are many irrational traders, and further suppose that their collective irrationality does not happen to balance out. In this case, observed prices can be too high or too low relative to their risk. Now suppose there are some well-capitalized, intelligent, and rational investors on the other side. Now these group of traders would see these high or low market prices as a profit opportunity and engage what is known as arbitrage, which means buying relatively inexpensive stocks and selling relatively expensive stocks. If these rational arbitrage traders dominate irrational traders, the market is still efficient. We sometimes hear the expression market efficiency doesn't require that everyone be rational, just that someone is rational. And here are the three main forms of market efficiency. So a weak form efficient market is a market in which past prices and volume figures are of no use in beating the market. So that kind of means then technical analysis is of little use because past prices and volume tells us nothing about what is going to happen in the future. So that is if you believe in weak form. If you believe the market is semi-strong form efficient, you believe a market in which publicly available information is of no use in beating the market. So if so, then the fundamental analysis that we do quite a bit is not effective either. And if you believe a strong form of efficient market, this means that information of any kind, public or private, so that means information that would normally be considered insider trading, is of no use in beating the market. A market is efficient with respect to some particular information if that information is not useful in earning an excess return. So a market can only be determined to be efficient with respect to specific information. Okay, and I gave you the three forms of that. If the information allows an investor to earn an excess return on an investment, the market is not efficient with respect to that information. So for example, if fundamental analysis lets us earn an excess return, then a market is not semi-strong efficient, and so on and so on. So why would a market be efficient? Why would this even happen particular? So there's kind of an example or a global example of that. So semi-strong encompasses weak, and strong form encompasses both of those. So the driving force toward market efficiency is simply competition in the profit motive. So take an example. So consider a large mutual fund such as Fidelity Magellan Fund. This is basically one of the largest equity funds in the United States with over $17 billion under management. Okay, $17 billion under management. Suppose Fidelity was able through its research to improve the performance of this fund by 20 basis points for 1 year. How much would this one-time 20 basis point improvement be worth? Well, the answer would be 0.0020, so 20 basis points, times 17 billion, which equates to $34 million. Thus, Fidelity would be willing to spend up to $34 million to boost the performance of this one fund by as little as 1/5 of 1% for a single year only. So this example shows that even relatively small performance enhancements are worth tremendous amount of money and create an incentive to unearth relevant information and use it. So some implications of market efficiency. If markets are efficient, then security selection is less important. Investors may as well hold index funds to minimize their cost. There's little need for professional money managers, so investors should also not try to time the market. In fact, successful market timing is very difficult to achieve, even ignoring market efficiency. So if you think about it, weak form efficiency. If weak form efficiency holds, technical analysis is of no use, and the efforts of technical analysis are of no benefit. If semi-strong efficiency holds, then fundamental analysis using publicly available information is of no benefit, and most of the financial analysis and mutual fund managers are not providing any value to you. If strong form efficiency holds, then inside information is of no value, suggesting that there should be no restrictions on insider trading. So you can kind of see where you're falling in these particular forms of efficiency, or where you think. Okay. So does old form or old information really help with our predict future stock prices? In its weakest form, the efficient market hypothesis in itself is a simple statement that stock prices fully reflect all past information. If this is true, this means that studying past price movements in hope of predicting future stock price movements is a complete waste of time for you. There's also something very subtle that's at work here. That is, no matter how often a particular stock price path has related to subsequent stock price changes in the past, there's no assurance that this relationship is going to occur again in the future. So researchers have been using some sophisticated statistical techniques to test whether past stock price movements are of any value in predicting future stock price movements. Turns out to be a surprisingly difficult question to answer clearly and without qualification. In short, although some researchers have been able to show that future returns are partly predictable by past returns, the predicted returns are not economically important. Basically what that means is that predictability is not sufficient to earn an excess return. In addition, trading costs that occur generally thwart attempts to build a profitable trading system. and researchers have been able to provide evidence of a superior trading strategy that uses only past returns. So no matter what, trading costs matter, and buy and hold strategies involving broad market indexes are extremely difficult to outperform. So while there is no particular pattern to the path that a stock price follows, the stock price behavior is what we call a random walk. So you have to ultimately answer the question if you believe that stock prices are predictable. And if you say yes, that's something you're going to have to pretty much defend. It is very difficult to predict stock market prices. So research has shown that stock price changes through time, they're kind of random. They increase and decrease, their increases and decreases are very equally likely. When the path that a stock price follows shows no discernible pattern like the one I have on your screen, then the stock price behavior is largely consistent with the notion of a random walk. And so a random walk is related to the weak form version of the efficient market hypothesis because past knowledge of stock price is not useful in predicting future stock prices. So we can illustrate the daily stock prices here. This is actually for, I believe, Intel. And these daily price changes are not truly a random walk. To qualify as a true random walk, Intel stock price changes would have to be independent and identically distributed. Still, the graph of these daily price changes is essentially what a random walk looks like. It certainly is hard to see any type of pattern that is going on in this Intel stock. So how does new information get into stock prices? Well, in its semi-strong form, the efficient market hypothesis is the simple statement that stock prices fully reflect publicly available information. Stock price changes when traders buy and sell shares based on their view of the future prospects for the stock, and future prospects for the stock are influenced by unexpected new announcements. So prices can adjust to new announcements in three different ways. Okay, three different ways, and you see those on your screen. The efficient market reaction is the price instantaneously adjust. Okay, instantaneously adjusts to and fully reflects all the new information. There's no tendency for subsequent increases or decreases. So instantaneously adjust. That's the big key there. The second is it could have a delayed reaction. The price partially adjusts to the new information, but days elapse before the price completely reflects the new information. And then it could have what we call an overreaction and correction. This means the price over-adjusts to the new information. It overshoots the appropriate new price, but eventually it falls to the new price. Okay, so that's kind of how information is given in particular to new stocks. And you can kind of see the different examples here. Days relative to announcements. So on announcement day, if it's an efficient market reaction, it's going to adjust immediately and stay current. If it's a delayed reaction, it's going to take a while or a few days to reach that price. And if it's an overreaction, it's going to go way above, and then it's going to come back down to correct to the new form of EMH. So we have included an event here, an event study for the Advanced Medical Optics, it's formerly EYE. And on Friday, May 25th, 2007, executives of Advanced Medical Optics recalled a contact lens solution called Complete Moisture Plus. This company took this voluntary action after the CDC found a link between their solution and an infection in the cornea called keratosis. Executives at Advanced Medical Optics chose to recall their product, even though they did not find evidence in the manufacturing process included this parasite. But researchers used a technique known as an event study to test the effects of new announcements on stock prices. Now, it's our experience that you really like to get a glimpse of an actual technique used by finance researchers. You will note that in this particular segment, we're going to look at the exposition on the reaction of the news rather than the method of how to do an event study. Here's the information I just told you. Actually, this even has the stock price on there. Opened at 34.47, down 5.83 from the Friday closing price. So you can kind of see the reaction there that has occurred. The price of shares for Advance, so you see it reacted extremely instantaneously, and it seems to be remaining in that segment, so it looks quite efficient. So when researchers definitely looked at this, in particular, they were kind of seeing that, wait a second, we got to see what's an abnormal return. I mean, is it really different from expected? So the expected return is calculated using an index of some sort, usually the S&P 500. So then they align the normal return on the stock to the days relative to the announcement. So plus 1 day before, plus 2 day before, plus 3 day before, and so on, right? So according to the EMH, the abnormal return today should only relate to the information that was released today, and they evaluate it usually over a 60 or 80-day period. So I'm going to show you a slide of the plot of the abnormal returns for American Optics in just a second. So here is the next, we call them cumulative abnormal returns, and this is just equal to the abnormal return on that day minus whatever it is, okay? So we can see if there's an overreaction or an underreaction for this particular stock. Here's the days relative to the announcement, and there's the actual returns. And what we find in particular, the abnormal return hovered around 0 before the announcement. After it was released, there was a sharp downward movement in CAR. Okay, you see? Whoop, sharp downward movement into CAR down here. And they're saying that this is a abnormal return, like it decreased too much. The overall pattern of the abnormal returns is essentially what the MEH would predict. So there's a band of cumulative abnormal returns, a sharp break, and then another band of cumulative. So you see it, sharp break, another band of cumulative abnormal returns. So interesting, different scenario. There's lots of event analyses that you can look at. So recall that if a market is strong form efficient, no information of any kind, public or private, is useful in being the market. However, inside information of many types clearly would enable you to earn essentially unlimited returns. This fact generates a very interesting question, and you see at the bottom, said, should any of us be able to earn returns based on information that is not known to the public? Well, in the U.S., this is illegal. You know, there is a ban said to be, investors are to have trust in the U.S. stock markets. The United States or the SEC basically enforces the laws that stop this insider trading. So when an investor makes a decision to buy or sell a stock based on publicly available information analysis, this investor is said simply to be an informed investor. This is completely legal. The information that an informed investor possesses can come from reading the Wall Street Journal, a quarterly report, gathering of financial information, talking to others, or a host of other sources. So you see that this is perfectly fine, perfectly normal, an informed trader making a trade. Now, legal insider trading. Now, some informed traders are also insider traders. So when you hear the term insider trading, you most likely think, wait a second, this activity is illegal. But a company's corporate insiders can make perfectly legal trades in the stock of their company. To do so, they must comply with the reporting rules made by the Securities and Exchange Commission. So when they make a trade, they report it to the SEC. These trades are then reported to the public. In addition, corporate insiders must declare that the trades they made were based on public information about the company rather than inside information. Most public companies also have guidelines that must be followed. Okay, so there is a form of legal insider trading. Now, for the purposes of defining illegal insider trading, an insider is someone who possesses material, non-public information. So such information is not known to the public, and if it were known to the public, it would greatly impact the stock price. So a person can be charged with insider trading when he or she acts on such information in an attempt to make a profit. So once again, it's not good to do what Martha has done, right, in the Martha Stewart scenario. Okay, so basically with Martha Stewart, kind of the example here is they believe that Ms. Stewart was told by her friend who founded a company that a cancer drug being developed by IamClone had been rejected. So this was definitely terrible news for IamClone. So she sold all of her shares on December 27, 2001. On that day, they traded below $6 a share, a level that Ms. Stewart claimed triggered an existing stop-loss order. However, the SEC believed that Ms. Stewart illegally sold her shares because she had information concerning the rejection of this drug. The FDA rejection was announced after the market closed on Friday, December 28th. This news was a huge blow, which made the shares close at $46 per share on the following Monday, right after it became public. Well, in June 2003, her and her stockbroker were indicted on 9 federal counts. They both pled not guilty. A trial began, and just days before the jury began to deliberate, judge dismissed the most serious charges of securities fraud. However, she was convicted on all 4 counts of obstructing justice. So the judge fined Miss Stewart $30,000. She had 5 months in prison, 2 years probation, and 5 months of home confinement. The fine was the maximum allowed under federal rules, while the sentence was the maximum the judge could impose. Miss Stewart's broker was fined $4,000, sentenced to 5 months in prison and 2 years of probation. So Martha Stewart was accused, but not convicted of insider trading. However, she was accused and convicted of obstructing justice. So now the question becomes, we all know that, of course, gave her an advantage. So can you really continue to or hold on to a strong, efficient market hypothesis? So that's really what happens is insider trading. Is it possible to hold on to that? Now, how efficient are markets? That is the question. So there are 4 reasons why market efficiency is extremely difficult to test. So there's lots of data out there. There's lots of analysis, but the problem is it's difficult to test the efficient market. There's a risk adjustment problem. There's a relevant information problem. There's the dumb luck problem. And then there's a data snooping problem. So all of these in particular are leading to some generalities based on the research. Short-term stock price and market movements are difficult to predict with any accuracy. The markets are quick and they react sharply to new information. There's little evidence that a market under or overreaction can be profitably exploited. And if the stock market can be beaten, it's not obvious. So that implies that the market is not grossly inefficient. So if markets are efficient, asset allocation is still important because the risk-return trade-off still holds. There's a small role for money managers, and it makes little sense to try to time the market. So there have been a number of studies that compare the performance of money managers with market indexes. The results of almost every study indicate that the market indexes outperform these mutual fund managers. This is further evidence in favor of market efficiency. Mutual fund managers should be experts in technical and fundamental analysis, both things that we look at in this class. They should be able to use these tools to earn excess return. Now, an interesting study by Fortin and Michelson, which I'm not sure your book refers to, but it compared the performance of a large sample of mutual funds categorized by objective to their respective market indexes. For example, growth funds compared to the S&P, corporate bond funds were compared to Lehman Brothers Index, etc., etc. The study found that on average, the benchmark indexes significantly outperformed the mutual funds for all fund categories but one. The one fund category in which the funds outperformed the index was small company equity funds. Apparently, the fund managers are able to exploit enough market inefficiencies in the small firm equity market to allow excess returns, which was very interesting to find. So you can kind of see here's a chart of those in particular. There's your total funds, and there's your funds beating the Vanguard 500, funds existing for 10 years, and funds beating the Vanguard 500 over the past 10 years. Not many, right? So it's hard to predict, hard to predict. All right, so let's look at some anomalies in particular. And this is just some more charts on how many funds beat. And here's the final thing, if you kind of wanted to know too, in only 9 of the 26 years did more than half beat the Vanguard 500. The performance is even worse when it's 10 years. Only 5 of the 17 periods during that time, half of the money, 50% of money managers beat the Vanguard 500 index. Now, I'm going to look at some more evidence concerning the performance of professional money managers. So this is data from 86 through 2011. We're going to calculate the number of investment experience, and we ask these 2 questions. What percentage of the time did half of the mutual fund managers actually beat the Vanguard 500, and what percentage did 3/4 of them? All right, so you can kind of see that in particular. Length of each investment period, number of investment periods, number that half beat, and you see the percentage of those that do that. Not that great. So there's some difficult questions for security analysis. If markets are inefficient and tools like fundamental analysis are valuable, then why aren't these fund managers beating the index? And it's very troublesome when we consider the resources that they have at their disposal, all the tools and the software that they have, and the fact that they're doing this on a regular basis, they still can't do it. So what's their role in an efficient market? So the role in an efficient market may be to simply build a fund to meet the needs of specific individual investors. So hold a well-diversified portfolio. Exactly which diversified portfolio is optimal is going to vary by investor. And some factors that influence portfolio choice include the age, tax bracket, risk aversion, even the employer. So just kind of depending what the employer offers as well. So we looked at some of these when we looked at mutual funds in our other chapters, kind of the different types of funds. There's many out there, and you can kind of see why there are many out there, because there are different needs for the different investors. Now, probably one of the coolest part about the market in a way that challenges this notion of market efficiency is a thing called anomalies. So researchers call kind of the reaction or the weird reaction of the stock market to certain behavior an anomaly. So the anomalies generally do not involve many dollars relative to the overall size of the market. They are fleeting, they tend to disappear when they're discovered, and they're not easily used as a basis for a trading strategy. Okay, so we can look at those. The first one's called the day of the week effect. There's a term for the tendency of Monday to have a negative average return. So table 7.2 that I have listed on the board or on the slide shows the day of the week effect that indicates that Monday is the only day with a negative average return. Notice that Friday has a high positive return. This effect, of course, is statistically significant, but is difficult to exploit it to earn a positive excess. About all we can do is use in our trading decision. Purchase a stock late on Monday and sell our stocks late on Friday. Now, there is an effect called the January effect that's even more amazing. So this is a tendency for small stocks to have really large returns in January for some reason. So this shows that the results of the January effect, small stocks tend to have much higher returns in January in particular, whereas larger stocks do not. They do not have as high returns in January. And you can kind of see the effect here. Returns in January versus the other. The bulk of the return occurs in the first few days of January. It's more pronounced for stocks that have significant declines. This effect exists in most major markets around the world. Two factors are important in explaining the January effect: tax loss selling and institutional investors rebalancing of their portfolios. So different ways there. There's also a turn of the year effect. They've looked into the January effect to see whether the effect is due to returns during the whole month of January or to just returns bracketing the end of the year. So now we look at our calculations concerning the turn of the year effect. All right, you can see the turn of the year effect. And it shows that the turn of the year days are higher than returns in the rest of the days categories. Further, the difference is apparent in the 1986 to 2012 period that you'll see, and it was twice as large in the 1962 to 1985 period. So there is a possible turn of the year effect anomaly that occurs. And you can see the daily turn of the year in the rest of the days. There are also some instances of bubbles and crashes and things of that nature. So that has occurred. A bubble basically occurs when these market prices soar in excess of what is normal and rational. So you're thinking the internet bubble that we had, maybe even the latest bubble on the financial sector. A crash are generally associated with bubble. They call it when the bubble pops. They're sudden, they last weeks. However, their aftermath can last a long time. Crash of 1929, one of the largest. You see it on the chart. The aftermath lasted quite some time. In particular, the crash of 1987. This began, the Dow plummeted 500 points. You see it in its aftermath. It took years for it to reach back up. And then you have something called, circuit breakers as the reasoning for the class of 1987. They believe that the circuit breakers were the reason for this crash, and that different circuit breakers are triggered if the S&P 500 index falls below 7, 13, or 20%. So once these circuit breakers kick in, the trading halts. So what had happened is, after the crash of 1987, it led to the installing of these circuit breakers. You see they have level 1, level 2 and level 3. We actually discussed it, or you listened to it on our videos. There's also something about the Asian crash as well that happened. You see that during that time period. The dot-com bubble crash, which is a very popular one in the 90s, these stocks had huge PE ratios and were significantly overvalued, and you see the crash that happened. They're very detrimental. The crash of 2008, which we just went through, kind of crashed to that low, and now it's slowly working its way back up. Same thing with the Dow during that time. So there's lots of different things. We didn't really talk about some other things such as the earning announcement puzzles. Recent research has found that it takes days or even longer for a market to adjust to earning information. Some researchers have found that buying stock after positive earnings surprises is a very profitable strategy, so it tends to stay that way. There's a PE ratio puzzle. Researchers have found that on average, stocks with relatively low PE ratios outperform stocks with high PE ratios, even after adjusting for other factors such as risk. So that's one. We mentioned the bubbles in particular and the crashes. So hopefully you're getting an idea of what's going on with the efficient market and the anomalies that exist. So there's arguments for both sides. And even when we look at behavioral finance in Chapter 8, it'll still continue as well. And that is it, Chapter 7.